Chapter 4-2, Completing the Accounting Cycle. Now let's look at reversing entries using Costco's rent transactions. In Case A, Costco is the tenant. It rents an office building for $3,000 a month. October's rent was not paid on time but delayed until November 6, when Costco pays for both October and November. This is an example of rent expense that needs to be adjusted at the end of October. In Case B, Costco is the landlord. It rents out space it owns for $900 a month. The tenant delays October's rent until November 10, when payment covers both October and November. This is an example of rent revenue that also requires an October adjustment. The question asks us to prepare adjusting entries as of October 31. Then, depending on whether we use reversing entries or not, we'll record the November cash payment and collection differently. The key idea is this: reversing entries are optional, but they simplify the recording of regular transactions in the new period. They clear out the accrual so that when cash is finally paid or collected, we don't accidentally double count. First, let's look at adjusting entries for Costco's rent transactions as of October 31. In Case A, Costco is the tenant. It rents an office building for $3,000 a month. Since October's rent wasn't paid on time, we need to record an accrued rent expense. The adjusting entry is debit rent expense $3,000 and credit rent payable $3,000. In Case B, Costco is the landlord. It rents out space for $900 a month. The tenant also delays October's payment. Here, we record accrued rent revenue. The entry is debit rent receivable $900 and credit rent earned $900. The key point is that these adjusting entries ensure October's financial statements reflect the correct expenses and revenues, even though cash will not be paid or collected until November. Second, let's see what happens in November if we do not use reversing entries. On November 6, Costco, the tenant, finally pays rent for both October and November. Since we already recorded October's rent payable, the entry must clear that liability and also recognize November's rent expense. We debit rent payable $3,000, debit rent expense $3,000, and credit cash for $6,000. On November 10, Costco, the landlord, collects rent for both October and November. Because October's receivable was already recorded, we now debit cash for $1,800, credit rent receivable for $900, and credit rent earned for $900. Notice how the entries require extra steps to avoid double counting. This shows why reversing entries can be helpful. Without them, we need to carefully split the payment between what was accrued in October and what belongs to November. Finally, let's see how things look with reversing entries. On November 1, we reverse the October accruals. For the tenant side, we debit rent payable $3,000 and credit rent expense $3,000. On the landlord side, we debit rent earned $900 and credit rent receivable $900. These reversing entries cancel out the October accruals. Then, when cash transactions happen in November, we can record them just like a normal month. On November 6, the tenant pays $6,000 for 2 months' rent. The entry is simply debit rent expense 6,000 and credit cash 6,000. On November 10th, the landlord collects 1,800 for 2 months. We debit cash 1,800 and credit rent earned 1,800. Notice how much simpler this is. By using reversing entries, we don't need to split payments between accrued amounts and current amounts. The accruals are cleared, and November's transactions are recorded cleanly. So to wrap up, we've seen 2 ways of handling accrued rent, without reversing entries and with reversing entries. Without reversing entries, we keep the original accruals in place and adjust cash payments against them. This approach is fine when accruals are small in number or when the accountant wants to keep a continuous record of payables and receivables. With reversing entries, we clear the accruals at the start of the new period. This makes recording cash transactions much simpler, since they look just like regular payments or collections. This method works best when accruals are frequent, such as rent, interest, or salaries. Both methods are acceptable in practice. The choice depends on the company's needs and the accountant's preference. The key point is that adjusting entries ensure the financial statements for October are accurate, and reversing entries are simply a tool to make November easier to handle. That's it for Chapter 4-2. Great work. See you in the next session.